Atlassian is a former Wall Street darling that is currently down more than 70% from its 2021 peak. While its growth rate is slowing, we still believe this is a very high-quality business with an incredibly bright future ahead. Here's why we'll be buying $250 worth of Atlassian stock today. Thanks to Common Stock for sponsoring today's video. As of the time of recording, I am not a shareholder of Atlassian.
And I am a shareholder of Atlassian, a $31 billion company that trades under the ticker symbol TEAM, T-E-A-M.
Atlassian's mission is to help unleash the potential of every team. This is simple, inspirational, and optional. Fantastic job.
The basis for how they accomplish that mission, they provide software tools that help teams collaborate and work together. The company got its start with Jira software, a tool for coders, but has since expanded to include the types of tools that even non-coders can use to help get their job done.
Now, Jira is still the company's most popular product today, but you may have heard of the company's other big products such as Confluence, which is used on content collaboration, or Trello, which is a visual project management solution.
And companies can use these tools to do just about everything that they need to, including analytics, automation, connection, collaboration, and even administration.
These products have allowed Atlassian to attract a huge number of customers over the last couple of years, which is a number that continues to compound to this day. As of the most recent quarter, this company has almost 250,000 customers across the globe.
Now, Atlassian got its start in 2003, which meant that it had primarily on-premise software, but it has transitioned to a software as a service model. And as such, the net revenue retention rate is very important. Amongst enterprise customers, it is above 130%.
Now, Atlassian is in the middle of transitioning away from a licensing model towards a software as a service model, and that is doing wonky things to its financial statements. That's an important fact to keep in mind as you review this company's financials.
Now, one of the things that we love about this company is they actually had to bootstrap it back in 2002 with $10,000 of credit card debt. That meant that they needed to make a product that was so good it could sell itself. And to this day, it spends very little on customer acquisition costs compared to its peers.
At the same time, the company's tools become embedded into an organization and they become a part of how that company operates. For that reason, demands for its services does seem to be recession resistant.
And the vast majority of the revenue that Atlassian collects is recurring in nature. Let's turn to the company's moat. We think that it has a weak network effect. One of the ways we see that is through the Atlassian marketplace, where third-party app developers can create tools specifically for Atlassian users. That can pull in more Atlassian users, which draws in more third-party app developers.
We also think there's low level of network effects within the companies themselves. Once a few employees start to use the company's tools, it behooves the other employees to start using them so they can communicate. However, we want to stress we believe that the network effect here is very low.
The key moat that we focus on are high switching costs. Once these tools become embedded company-wide, it is a pain to switch to a different provider and retrain employees on a completely different interface.
We also think there's a strong argument to be made that the company's brand name and product brand names do hold a lot of esteem within their communities. That is because the company doesn't have to spend a lot of money on sales and marketing, and the products sell themselves. So we give the company credit for having a strong brand name.
You add all that together, and we believe that even though there is some pressure on the company's growth right now, the moat is expanding around the business.
Turning to the company's annual financial growth, the numbers are largely impressive. Revenue has grown at a 32% compound annual growth rate over the last 3 years when looking at a fiscal year basis. Gross margin is very high at 83%, and net income is negative on a GAAP basis, although the numbers are far more pleasing on a non-GAAP basis.
And we can see that they're more pleasing on that basis by looking at the free cash flow, which has been strong and positive for a number of years. The balance sheet is still in good condition with over $500 million in net cash, but returns on capital are negative while amortization is taking its toll on the income statement.
Turning to management, this is one of the most beloved management teams in all of technology. Atlassian was founded by Scott Farquhar and Mike Cannon-Brookes almost 2 decades ago, and both of those co-founders remain in the corner office today.
How beloved are they? Well, they get absolutely stellar reviews on Glassdoor.com, and they have a ton of skin in the game. Them combined with the rest of insiders own 45% of shares outstanding, worth about $14 billion today.
So how about potential? Well, we think this company has a decent amount of optionality built into it. Atlassian has a history of creating and rolling out new products that prove to open up new revenue opportunities, and the company also makes acquisitions that tuck into its core product offerings.
When we look at operating leverage on a GAAP basis, there's still room for growth. On a non-GAAP basis, a little bit less, but margins can still expand moving forward.
So how big is the potential pie here? Well, management believes that its total addressable market opportunity will be about $60 billion by 2025, of which it's currently captured about 5%. However, that total addressable market could grow as the company continues to roll out new products and potentially make tuck-in acquisitions.
And as we said, not all of this growth is organic. Atlassian does have a history of making medium-sized acquisitions to add to its product roster.
So how has Atlassian done for its shareholders so far? The answer there is fantastic. This company is a multi-bagger since it IPO'd, and it's still outperformed the S&P 500 over the last 5 years, which is very respectable given that the stock is currently down more than 70% from its 52-week high. Moreover, the company does have a history of meeting or exceeding Wall Street's targets on the bottom line.
Now, while cash flows are significantly positive and growing, the company is not yet at the point where it's returning that cash to shareholders. We're okay with that because there's a huge opportunity in front of it.
Sounds good so far, right? Well, there are a handful of risks that investors really need to keep in mind. The first one we want to focus on is competition. Atlassian is facing off against big tech companies such as Microsoft, Google, and ServiceNow, as well as a slew of smaller focused competitors such as Asana. Atlassian has a history of continuing to grow its customer base despite that competition, but it would be a mistake to overlook it completely.
Beyond that, there aren't a whole lot of other risks to note for the business itself, but the stock, though is down over 70% from its highs, is still richly valued. More on that in just a minute.
So how did Atlassian do in its most recent quarterly results? The answer there was mixed. Revenue growth came in at 31%, which exceeded Wall Street's estimate and management's own guidance. However, earnings per share are currently under pressure as the company's expenses remain relatively high compared to where Wall Street thought that they would be.
And we can see those forces playing out by looking at the margins. Now, gross margins coming down slightly is not terribly surprising given the migration to the SaaS model, but operating and net margins were down markedly as the company, like many other tech companies, has increased its spending while revenue growth has hit the brakes.
On the plus side, free cash flow continues to remain positive and is growing. Net income is holding steady, and the balance sheet has plenty of net cash to fund the company's operations indefinitely.
When Atlassian came out with their earnings, the stock fell quite a bit, and this is the main reason. In giving guidance for the current quarter, management's midpoint calls for 23% growth. That is well shy of the 28% growth that Wall Street was expecting. The reason for this shortfall? Atlassian's products are used primarily by big tech companies, and no sector has been laying off more workers than big tech companies. Because of that, there are fewer seats that need to be filled by Atlassian's products, which holds back that top line growth.
Now, management does not issue full year guidance. However, Wall Street is currently expecting 29% growth to about $3.6 billion. It's possible that that number could come down over time if the tech layoffs continue.
So what should shareholders like ourselves watch moving forward? Well, first, keep an eye on that revenue growth, especially as those tech layoffs continue.
Second, keep an eye on the company's operating margin and expenses. While many of the company's peers have been laying off employees, Atlassian has chosen to actually continue to invest in itself and hire them. That's going to keep its expenses very high, so we want to keep an eye on that operating margin.
Third, keep an eye on free cash flow. Now, historically, this company has been a cash-generating machine, and we expect free cash flow to still be positive. Growth might be tampered in the short term while it is investing in itself and revenue is pulled back, but over the long term, we want to see it continue to grow.
And finally, keep an eye on new product uptake, especially within companies that are already using the company's products. This not only opens up new revenue opportunities for the business, but it also increases the switching costs of those companies.
Now, overall, we believe that the moat surrounding Atlassian's business is stable and probably widening. Most of the problems are macro in nature, and the thesis is very much on track for owning the stock.
So how did Atlassian score on our investing frameworks? The answer there is great. On mine, it got a quality score of 81, which is well into my high quality business category.
And on mine, it got a 12.5, one of the few companies that is in the anti-fragile range.
So how about Atlassian's valuation today? Well, first, let's consider where it is in its growth cycle. We believe that Atlassian is somewhere between phase 3 and phase 4. So the best valuation metrics to look at are the price to sales, price to gross profit, and the price to free cash flow ratio. Price to earnings is not yet fully useful because the company isn't yet hyper optimized for profits.
Let's take a look at those metrics. On a price to sales basis, Atlassian is trading for about 10 times trailing sales. Now, that is high compared to the rest of, say, the S&P 500, but as you can see, it's the cheapest that you could buy stock of Atlassian in a number of years.
If you look at Atlassian's gross profit, this number continues to grow and currently clocks in somewhere around $2.5 billion. When compared to the company's market cap, that gives this company a price to gross profit ratio of about 12. That is high in absolute terms, but we think it's reasonable given that this company is a high quality business that's still continuing to grow.
Or how about the company's price to free cash flow ratio? You can see that it's just trading for about 36 times free cash flow, down significantly from where it was at the beginning of the year and in line with some of the best deals you could get in the company's history. Now, we also think it's worth investigating what analysts think growth will look like going forward.
Wall Street is currently estimating that this company's revenue growth rate is going to slow in the next year. However, it's still expected to remain well over 25% for the next 5 years.
At the same time, Wall Street expects there to be significant operating leverage ahead, with net income and free cash flow margins expanding considerably moving forward.
That makes us believe that the company's valuation today, while high, is still palatable if the company can achieve those targets. Head on over to Common Stock and let us know what you think of this investment. We're going to read through the comments and pick the best one, and Common Stock is going to reward that person with a $100 cash prize.
We want to give a shout out to Hilario, who left a very detailed and interesting comment as an oncologist on our decision to purchase shares of Novacure a few weeks ago. Common Stock will be sending Hilario $100.
So there you have it. That's why we're going to be buying shares of Atlassian stock today. We hope you enjoyed this video. See you next time. Brian's out.